Welcome. I'm Andrew Horowitz, and I am president of Trigger Charts. And today I want to talk to you about something that I think is really interesting and important, because when we think about trading, what do most traders do? Well, we're looking at where are our entry and exit points, and that's a great thing, and it's a very important thing. But when you consider the idea of risk and you consider the idea of trade sizing to ensure that your trades will work well over time, that you can withstand the volatility in your trade, it's really important to consider the idea of this trade sizing. Now, without proper and consistent trade sizing, you could really have a problem. Think about this for a second. What could happen if you allowed your portfolio and positions to move away from you by 10% every time you set up a position? In other words, you're willing to take a drawdown of about 10% on your position. Do that 10 times and take 10 drawdowns of 10%, you're virtually going to wipe out your portfolio. So what we want to consider is the idea of fixed fractional. And fixed fractional takes this idea of looking at a 1% drawdown potential, the stop loss or the loss factors that you have with that position, and applies it to your portfolio. Now, whether you're looking at a stock or you're looking at futures or a Forex trade, what you want to do is you want to have this 1% level that you are willing to take in terms of that. And you have to then calculate, well, what is that going to be for my size portfolio? So if you have a $25,000 portfolio and you have a 1% fixed fractional trade stop or loss factor that you're putting into your overall calculation of when you trade, what you want to do is you want to consider the idea of, okay, well, I'll take a $250 loss. Well, then calculate that against how much is in the actual loss factor for that instrument. When you're looking at futures, for example, and depending on the future, if each tick is worth $25, and you have a $250 total loss factor that you're willing to take on that position, well, then you're only going to be trading 10 contracts. Same thing as goes with options, that you may want to look at where that level is that you'll take that stop loss. It may go for stocks as well, and you can look at where that level is. Now, stocks are a little bit different because they're a little bit more straightforward. ETFs, the same thing. If you know you're only willing to lose 1% per position, and that's that fixed level, you can obviously set either a stop loss factor in the portfolio, or what you could do is use a trailing stop factor, particularly for stocks. But really, one of the problems is that if you don't use any kind of real good overall trade sizing in your portfolio, it could take you from here to there and back again and just compound, build, and grow those losses, because if you're not setting up properly to affect basically your portfolio right, and you're not properly sizing it in that you're taking outsized losses against only small gains over time, it's going to end up being a loss. So consider the whole idea of this trade sizing, this fixed fractional, to be used in your portfolio concept and trading mechanism to manage your risk better. I think it'll do a lot of good for you.